My group is me, Dani, and Alice. Our company chosen is Hallenstein Glasson's group. So I will talk about the financials analysis. So the first point that I'll talk about is the key information about the group. And then I will talk about the ratios, the profitability, liquidity, asset utilization, debt utilization, cash flow life cycle, and credit policy as well. So about the key information, Hallenstein Glasson's group is the one of the biggest company clothing industry in New Zealand for both women and men. Because I think in the 10 years ago, Glasson's was just one store for men and women, but then they divide. So they have Hallenstein for just men and Glasson for women. They have 114 stores in New Zealand and Australia. And they have 1,734 employees, so which means it's a huge company. For their sales, they have over 2,000 million per year, and the profit after tax is 28 million, thousand million. Sorry. So it is a huge company, and as you can see here, it's good to investor because it's a big amount for the profitability. Okay, sorry. Can about the products, Glassons has the pants, jeans, shorts, like everything, the accessories, belts, swimwear, and also I think yeah, that's all. Yeah, sorry. Okay, now I'll talk about the profitability ratio. So the first one is the gross profit. The gross profit is the how you can calculate that is the gross profit divided by net sales. So multiply by 100 because we need the percentage. So as you can see here, in 2018 it was 61%, and in 2020 drop off to 58. Probably because the COVID situation, they drop a little bit of the gross profit, but also they have a little bit more net sales. So the gross profit is the net sales less the cost of goods. So probably they go up a little bit the cost of goods. The net profit ratio is the net profit divided by net sales multiplied by 100. So we can see that didn't change too much between the years, the 3 years. So which means that they have the net sales up like over 2,000 million, and the net profit didn't change too much, just like to 1,000 and something. The return on assets, we can see that they have a huge difference here. Because here we have 41% and here 18%, so drop off like 20%. It's too much for just 2 years. It's because here they have the total assets, they double the total assets here, but they didn't change too much the net income. So that's why they have the huge difference return on assets. So, and return on equity just changed 10% between the 3 years. It's not that much, but we can see that here they have the shareholder equity a little bit like lower than this one. This one is like huge, which means it's good for the company because they increase a little bit the shareholders equity, and they didn't change too much the net income, so the shareholder can receive more than this one. About the liquidity ratio. The first one is the current age ratio, which means the working capital. Is the current assets divided by current liabilities. So they're good because it's more than 1 point, so which means it's good. 2019, which was almost 2, and drop off up to 1.1, which means just drop off a little bit because the current liabilities went up like 40,000, almost 40,000, and also the assets went up as well. The quick ratio is the current assets less the inventory divided by current liabilities. They drop a little bit, but I think that all the ratios drop a little bit because of COVID situation, so that's why like every ratio went up, down a little bit. So here they went a little bit down as well. So for the assets utilization, we just have the interest expense for the 2020 because they got a lease in this year. That's why we have the interest expensive. And the 2019 and 2018, they didn't show, so we couldn't calculate that. And the debt utilization is the inventory turnover is the cost of goods divided by inventory. So they went up a little bit as well compared to 2018 to 2020. But 2019 to 2020 didn't change that much, just a little bit. So because they just slightly changed in the cost of goods and the inventory. And the average accounts receivables period is like 7 days more. So they have like before they have just 6 to almost 1 day, and then here they have like 7 days to get the receivables. Now about the cash flow life cycle. So we get the cycle, the complete cycle. We have to do some calculations before. So the first one is account receivable. That is just 2 days to they get the accounts receivable. So they get the money is a little, for me it's like very, it's good because it's just 2 days to they get the amount of money. And the payable, they have 30 days to pay their bills. So which means it's good because they can receive in 2 days, but they can pay in 30 days. Open also.
Sorry.
That's all right. So the cash flow life cycle is the operating cycle as the accounts payable. So they have 48 days to have the money and to get the company working well. So after that, the company probably will get trouble with that. And the last one is about the credit policy. So they have 3 types of sales that you can buy. The first one is the website, the second one is the app, and you can go to the store to buy. And they have some types of credit that you can pay. So you can pay by credit card or debit card, such as American Express, Visa, and MasterCard. And they have Afterpay and Lay-by. So the Afterpay and the Lay-by is not the Glassons or the group that chose that. It's the app that chose that. So the Afterpay is interest-free, and you can pay in 4 fortnightly weeks. Statement, sorry. And Lay-by is 6 weekly payments. So you can choose, and you can use Afterpay in store as well, because some companies you cannot do that, but in Hallenstein Group you can. And if you go to the store, you can buy in cash as well. So that's all.
Okay, well done, Renita.
Good, good. Any questions, guys? No questions? Oh, okay. All right, so well done, Renita. So very clear, and I like your talking pace, right? That's really good. Okay, but I do have little bit of questions here. Okay, so the thing is, when you talk about, let's say, when you calculate the current ratios, right? So you mentioned the rule of thumb is actually 1, but 1 is actually for the quick ratio. Should be 2. Okay, so which means you need to compare your calculated answer with these 2.
I did this in my project, but I didn't do this here. Sorry.
Yeah, I think maybe your memory have a little bit confused here.
Yeah, probably.
Yeah, and so therefore, as for your quick ratio, you can compare it with 1, right?
Okay.
Yeah, then you can make your justification here. Okay, and then also it's like for the ROE, it's also is like actually because the number is actually decreased from 2018 to 2020. Decrease, but when you actually explain it, the other way, opposite way.
Yeah, because
so,
it was zeros at the beginning.
Okay, yeah. And then it's like, so it's very good for you to show us the detailed formula and steps and give us the interpretation about like how you get there, and you provide some of your justifications. So this is really good. Okay, well done. Okay, thank you.
Well done.